What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I want to talk about how buyers can be more creative when offering on multifamily properties, when pursuing multifamily deals. And broadly speaking, I think that most multifamily buyers are not really that creative. And I know that's a general statement, but when I say creative, I mean they just approach deals the same way and they lack an approach to offering and making offers on deals where they're actually structuring the offer to speak directly to that particular seller, or where they give themselves a chance to pick up more value, get started on the business plan, etc., when they're actually buying the deal that they're pursuing. All right, everyone. Before we get to the rest of this episode, I have one simple and easy request for you, and that is to share this podcast episode or the podcast in general with anyone in your network who you think would find the content valuable. The only way we can grow this show is by sharing it with folks who we think will learn something from its content. So, if you have someone in your network, whether it's a friend, a colleague, a business partner, your dog, the guy across the street, I don't care. If you think they would enjoy the podcast, please consider emailing it, texting, or sharing it with them however you see fit. As always, thank you for listening. You guys are the best, and enjoy the rest of this episode. And I think this is a really topical time to have this conversation, given one, that we're entering a season of the year. I mean, at least in New England, but I believe this is a dynamic nationwide where deal making slows down, primarily because more buyers are just kind of shutting it down as we head into December and post New Year's into January. And then broadly, just from an economic standpoint and from a broader real estate market standpoint, more of a buyer's market now than it has been over the last few years. So if you're a buyer now, you're going to be taken more seriously by sellers, just again, very broadly speaking. So what that should allow you to do is to get a little bit more creative in the offers you make. And I'm going to get into a whole slew of different examples of this. But what I'm talking about is not like, okay, now I can make these crazy lowball offers that carry, a bunch of seller financing. Like, no, I mean, broadly speaking, I think the fundamentals of your offer will probably remain the same, but there are opportunities around the edges when buying deals right now where investors can get started on the business plan, can take over the property in a different, in a more optimal state once they close, can provide options to the seller that push them into a structure that makes a little bit more sense for you as the buyer. And what I'm going to do is talk about a handful of those right now. So let's get into it. Number one, as it relates to debt, I want to talk about debt. And this is actually outside of anything that that you'd speak to a seller about. But as it relates to debt, and this is specific to, I shouldn't say specific, but more specific to value add deals, try to get creative with your lender as it relates to different types of pushback you may get from them when underwriting a value add deal. So for example, in our business, we pursue a lot of mom and pop owned buildings who have been owned by these owners for a long-term period of time, 7, 10, 15 plus years, where rents have now significantly lagged behind market. Tenants are paying $1,100 when they should be paying $1,500, $1,600. And as a result, the deal is not very lendable to, or at least for stabilized debt, a local bank, a local credit union, etc. And that said, we still want to use, stabilize debt as much as we can, right? We get a longer term on it, we get a better rate on it, etc. And maybe we're looking at a deal, and this has happened a handful of times over the last few months, where the in-place DSCR is below a 1, and that's where the bank starts to get a little nervous, right? They are going to have to lower the LTV to a level that makes them feel comfortable with the debt service coverage. Obviously, as a real estate investor, as a buyer, you want to maximize leverage responsibly. And without going too crazy on the leverage side, you want to pick up the most you can while remaining within your risk profile. And a stabilized loan at 60, 65 LTV on the buy side versus 70, 75 hurts your returns, right? It makes it more challenging to get the deal done. So something that we've been negotiating with lenders on these types of deals, because we do a lot of them, is some type of upfront interest escrow versus just reducing the LTV significantly. And let's say we have a bank that's like, all right, we originally wanted to, we were going to get 75% loan to cost. Then they realize that in place NOI is very low, non-existent, what have you. And now we're dipping below 65 in terms of what the bank's willing to lend. And we got to come up with 10% more in equity. Well, an alternative solution to that that makes more economic sense as a buyer, when you model this out from a return standpoint, is offering to escrow some amount of interest payments. Maybe we're offering 6, 9 months of interest payments at escrow at closing that is drawn down upon that allows us to work through the stabilization process, in some early capacity that gets those rents to a point to where we're going to be above the minimum required DSCR. And that way we still retain the original loan balance. Alternatively, we could structure or negotiate an earnout of some kind where maybe they're extending less at closing, but the bank is putting back the difference between the 75 LTV and the 65 LTV into some escrow account. They're holding on to it. And once we exceed some minimum rent roll or some NOI threshold or some DSCR thresholds, the bank will then release those loan funds and will increase the loan amount. That's something that we've also negotiated. But broadly speaking, there are many different things that you can propose to a bank, those being kind of the two most common ones, to reduce your cash required to close and to actually, maybe even keep a deal together where a lender may just like not even be interested in doing the deal, let alone adjusting the terms. So that's number one, I think, is you got to get creative with lenders now on value add deals as their risk profiles start to, tighten up. And again, this is really specific to those kind of mom and pop value add deals with very low in place NOI. Number two, and this is, I think, where we're going to spend a lot of our conversation here, is collaborating with sellers while you're under contract to pursue a deal. So, or I should say, even before you're under contract, right? Incorporating this as part of your offer. Now, the offer typically has the big stuff, or always has the big stuff, right? You got the purchase price, you've got a due diligence timeline, you've got your maybe financing contingency timeline, you've got your closing timeline, etc. Now, I think that's kind of where most people stop when they think about structuring their offers. Maybe they move them around. Maybe they're like, all right, we'll tighten up our DD a little bit. We'll tighten up our financing a little bit to make our offer more compelling or what have you. But there's a whole slew of things that you could throw in the additional provisions of an offer or, outside of the standard price and terms that may help you as a buyer and that may be value additive to the seller, right? Because despite the fact that you think you know a lot about the seller situation, you probably don't know everything. So here are some examples. Let's say you're buying a 20-unit multifamily deal. It's a value add deal. You got some low rents. You've got leases that are expiring periodically over the next few months, 6 months, whatever. Maybe you got a couple of month-to-month folks. But there are a handful of units that you've already eyed as the ones that are really low on the rent roll that need a lot of capex that you'd like to get into right away. Or maybe you've got some problematic residents in there that you already know are going to be, problematic once you take over. Something that you can do is, knowing that that's going to be part of your business plan, is incentivize the seller to help you get started on your business plan. And again, right, you could just throw it in the additional provisions and say, hey, look, if units 2, 7, and 10 are delivered vacant, we will increase the purchase price by X dollar amount. Or you can say, for each unit out of units 2, 7, 10, whatever it is, that are delivered vacant, we will increase the purchase price by $5,000 per unit, that is delivered vacant, or however you want to paper it. Basically accomplishing the objective of, we want to get into those units ASAP. And maybe the seller can then just go behind the scenes and make an offer to these tenants for, a cash for keys of $3,000, $3,500, knowing that they're going to keep the difference if they do vacate. And you've taken over and you're now saving time on being able to implement your business plan. You can rapidly renovate and lease those at market. And you don't have to deal with the challenges of maybe working through a unit vacating, right? And you can then enlist the seller to help you with your business plan. And obviously, yeah, you're leaving some money on the table here, right? In this hypothetical scenario. But we oftentimes forget that such a function of IRR and maximizing returns in real estate is the velocity of your money. It's the speed at which you can execute your business plan. It's your ability to go from closing to stabilized property or executed business plan in the shortest amount of time. So if there's a way in which a seller can help you do that, then you should be incentivizing them to help you do that. Some other examples of this could be maybe handling certain renovations at the property, right? Hey, if let's say you've got to do some roof work, you got to do this, you got to do that, offering them dollars to either do it or just asking the seller, hey, we'll sign a liability release of some kind. Do you mind if we get in there and start working before we close? Maybe that's renovating a unit. Maybe that's doing some work in the common area. Other examples of this are negotiating lease renewals. Like, let's say, for example, you've got a handful of units in a building where leases are coming due in the shorter term, but they're pretty close to market and you've walked their units during DD and these units look to be in good shape. You don't think that these tenants are going to be problematic once you take over for one reason or another. They have good payment history, whatever. You think you want to keep them. Well, let's say you can incentivize the seller to get them on, your lease agreement and say, hey, if you sign leases with these tenants at these rents, we'll increase the purchase price by X, right? And now you're reducing the chance that these units vacate as part of the uncertainty that comes with a sale or that they convert month to month while you're under contract and that, they get a little nervous and put in their notice and plan to leave. So there are a whole bunch of things where if you start thinking about like, hey, what am I going to do with my business plan post close? Like, what is my business plan on this building? And you incentivize the seller economically to help you with that, and therefore it helps to reduce your timeline to actually executing this business plan. Well, great. That's something that you should be thinking about because it helps you to do it, it'll help you basically drive the velocity of money, right? Which is what we're trying to accomplish here. Another thing that we specifically work on or that we really try to incorporate at the end of a year is thinking about when we want to close a deal, right? And it's a little late in the year to really to put this into practice because by the time a lot of you guys are listening to this, the deals you're putting under contract are 100% going to be closing in 2026. But we do a lot with staggered close dates. When I'm a seller, for example, and we're selling a deal around the end of the year, especially a partnership deal where our goal is to sell the building before the end of the year, finalize the accounting so that way we can then just close out the entity and not pay for one more year's tax return, pay the CPA. We will incentivize the buyers by basically saying, look, this is the purchase price, but if you get it done in 2025, we'll reduce the price by $2,500 or something like that. And that'll then drive them to get it done before the end of the year because they're buying the building for less money. And economically, we're saving a little bit of money on doing an additional tax return. You could do the same thing as a buyer, right? Hey, we're going to close in 26, but if it's of value to you, and we can close in 25 and save you guys, a tax return filing for this entity or whatever. We'll, and you're willing to take a couple grand off the price, like that's something that you can throw in there. And let's say you're going to be able to get it done by within that calendar year. And in the alternative is you might have just closed earlier because you had the ability to. Well, now you're picking up a little value in doing so. And that's something that can be easily communicated to a seller. The last thing, I should say, well, basically the last thing I want to mention, even though it's kind of a two-parter here, is seller financing is always what everyone, very quickly brings up when they talk about creative deal structure. And it's true. I mean, seller financing is something that can help get a deal done. I think it's very overblown in terms of most investors are never really doing seller financing deals. Like we've done a handful, but very rarely is a deal able to be executed with seller financing because stabilized debt hardly allows for it in the first position. A first position local bank, local credit union, if you're doing a deal with an agency, they don't want second position debt underneath them. That's again a broad statement, although it does happen. And most sellers just want to take their money and go home. I think that's oftentimes the other piece of this. But what I will say is similar to the point number one, where let's say you have a value add deal with low in place NOI, you're gonna have a hard time getting this deal done and financed at a reasonable LTV because of the lack of in place NOI. These are good opportunities to suggest seller financing. And I think oftentimes we'll go to a bank, we'll say, hey, look, be upfront. If we're pursuing this deal, like, hey, we are pursuing this deal. The rents are really low. It's probably only going to size for you to like a 65 LTV, but the seller is willing to hold 15% of the equity on a 2-year term at a low rate. This is our projected all-in DSCR. Now we're just over that 1.0 debt service coverage. You guys are in first position, etc. Some local banks are going to be comfortable with that if the blended and total debt service, meets their internal requirements. That said, you're going to have a harder time finding these banks than just doing a regular deal. But I think that is something that is becoming a little bit more commonplace now, as especially as sellers get a little bit more motivated to get out at a basis that they're happy with. Now, alternatively, something that you can communicate to a seller that I think is interesting is staggered interest rates, right? And once you get into the world of seller financing, there's, it's Pandora's box in terms of all of the different financing structures that you can put together. But oftentimes, what you're going to find as the pushback from a seller is, okay, but I don't want the money out that long, right? I want a shorter term on it. I want to be paid off sooner than later. And maybe that doesn't, technically align with your business plan, right? Maybe they want to be out by the end of year two, but like you're like, hey, this is a 3-year business plan or something like that. Or they want to be out by the end of year one, but you've got a 2-year business plan and you don't want to have to pay them off. You'd rather just refi the whole thing when it comes time to do that. Well, I think that there are many times, or there's oftentimes opportunities here to structure seller financing where you have a rate in year one and then you have a much higher rate in year two, right? To where it's, or some higher rate. Maybe it's 3% in year one, 7% in year two, 10% in year three, or something crazy like that, where it's like, look, if the money still, remains out, we're going to structure the loan docs to where you're going to be very well compensated as a lender throughout year two. And yeah, we have the term, but we're going to be really incentivized to pay you off. And I think that getting unique with the structure around a second position is oftentimes what's going to help you get a deal done, where that may need to be an essential part of the deal. Lastly, I think I'd be remiss if I didn't at least bring up seller credits, which is oftentimes how we're structuring many deals now, where again, maybe we are in a deal that doesn't necessarily work for the lender for one reason or another because of the low in place NOI. But what we then do is increase the purchase price with the seller and say, look, we're going to have these NOI challenges. Our bank's not going to give us a good LTV. I know we're paying you 1 million, but let's increase the purchase price by 25 grand. And then you give us 25 grand back at closing. So you're basically netting the same amount of money. But then we take that 25 grand and we go over to the lender and say, hey, look, we'll put this into escrow as an interest reserve that you'll be able to draw down on for the first 3 months or something like that. And we can oftentimes get the seller to credit us the required amount of dollars to go back and then have that conversation with the lender, because the seller's walking away with the same amount of money. But because of, we're picking up a credit, now we're able to go back to the lender and use that credit to actually help us from a DSCR standpoint, which is another unique solution. Seller credits, I'm always a huge fan of, because you're functionally allowing yourself to finance a little bit more of the deal while reducing the cash required to close. Or I should say, because you're reducing the cash amount required to close. That's why you're therefore increasing the LTV. So if you have to do a lot of CapEx, or you run into some issues during due diligence and you're thinking about negotiating a price reduction, or it's a deal that requires a lot of CapEx and you're thinking about a price, or you run into some other types of challenges while you're under contract where you want to retrade, the easiest way to do it in my mind is to always think about going the seller credit route versus reducing the purchase price, so that you're actually functionally reducing the equity that you're bringing at closing. And you can go upstream with this too, and suggest right off the rip when you're offering on a deal, look, we're willing to pay 750, but we want to bring a little less money to closing, and that's something that we're going to work out behind the scenes on our side as a buyer. But a simple deal structure that allows us to do that is to pay you 775 with 25 grand back. Therefore, you're walking away with 750. And the seller is going to have some incremental closing costs that increases as a result of this. For example, now they're paying transfer taxes on a slightly higher purchase price, but usually the difference there is like marginal. It's like, hundreds of dollars, at least in the scenario that I'm proposing here, in the 750 range. So broadly speaking, there are some implications, but that does help a lot of deals pencil a little bit more when you're close on one. So long story short, there's a little bit more of just kind of a free formed thought episode here, where I'm sharing some things that we're doing in our business to kind of help us structure deals that create a little bit more sense for us, and to help us pick up some value on the margins. And if you found this episode to be informative, valuable, helpful, please consider leaving the podcast a rating and review. We have crossed 300, which I very much appreciate. Thank you to everyone who has left a review. 300 plus is a nice number. I mean, it truly does mean we're one of the highest rated real estate podcasts. I mean, definitely multifamily real estate podcasts, and is a nice goal for us to hit that I'm very happy about. But thanks again for everyone who has listened over the years. Best of luck as you begin the home stretch to end the year, and I'll catch you guys next week.